Today, we're going to compare and contrast two of the most common types of investments for private investment: real estate and private equity. What are the pros and cons, and how are they different? First, we'll start with real estate and some of the different components that you might consider if you're going to make that type of investment. So some of the pros are going to be, obviously, it's a tangible asset. You can go and visit it. It's a physical location, tends to hold its value pretty well. It's stood the test of time. A lot of millionaires are made in real estate. Now, the contrary there is going to be the majority of billionaires are made in private equity, and we'll get to why that is in just a second. But so some of the pros of a hard, tangible asset, it's going to produce cash flow for you. It's going to pay you on a monthly, quarterly, annual basis every single year. If it is under a property management company, obviously there's going to be fees associated with that, or you can manage this yourself. And that might be a pro or con, depending on how you look at it and what you want to do. Most people are going to look at that as a con. You're going to have to actively be involved unless you're paying a management company. You're going to have appreciation on the asset in most of the circumstances if you've bought it well. We're about to come into a time, I think, with interest rates where they are. If the Fed doesn't lower interest rates over the next 12 months, you're going to see continue onslaught of people that are upside down or stuck and have to refinance after a certain period if they got into a variable rate on the loans that they took out on the pieces of property. They're going to refinance, or they're going to have to liquidate their positions, sell onto the open market, and there's going to be opportunities for people for distressed assets in those situations. If you come in through a fund on real estate, it can be passive, right? So like a REIT, a lot of people think about that, and those are actually pretty liquid. They still pay you the dividends. The yield on those and the appreciation is not going to be as high as, going in on a specific property, either on the management side or as an LP on a deal, but can also be very lucrative depending on how actively or passively you want to be involved with the investment. Cons are going to be, it's illiquid for an extended period of time. That's why a lot of people get in stocks and bonds and other markets that are more traditional. Is they're very liquid. You can get in and out of that. Obviously, a lot of people watching this are going to be in crypto, very easily exchangeable asset there. With real estate, if you do opt to sell it, depending on what the market conditions are, it could be an extended period of time before you could get in and out of that. And most of these are going to be longer term investments. Some of the other cons, besides being illiquid, you're going to have a manager for the property, like I mentioned before. That could be you or another party, fees associated with that. Depending on interest rates and some of the other constraints around where you purchased the property, if let's say property values there have come down significantly over the last couple of years because of conditions outside of what's existed previous. So those are things outside of your control completely. You could have purchased stuff in that area hoping for appreciation, and now you're upside down on those assets just because of circumstances that happen. So you always want to do due diligence. Same with either one of these investments. And then the last piece that's kind of a con for real estate in general is just a significantly high barrier to entry. If you are going to be participating in that type of investment, you're going to have, a minimum of $30, $40, $50, $100,000 just to get into that game, whether it's a small family property, single family property that you're getting into, or maybe it's a passive investment on a fund or syndication. Most of the time, the minimum threshold there is $50,000 in both circumstances, whether you're financing the property. So it's really not, the barrier to entry there is going to cater itself toward accredited investors that have more capital to be able to participate. On the private equity side, the initial investment's down to $5,000. We also do that in our mastermind group through some of the private funds that we run there. We want to make sure that, people have opportunities that they otherwise wouldn't. But some of the other pros that you might have for private equity outside of, kind of a lower barrier to entry in some circumstances is going to be diversification of your portfolio, right? So private equity tends to be non-correlated with the stock market, whereas real estate often is very correlated with the stock market. 2008, 2009 happened. We saw a significant downturn in real estate, significant downturn in stocks. Over the last couple decades, private equity has significantly outperformed both of those asset classes. So That's one of the pros here. Oftentimes you're going to have professional management. If you are participating in private equity, it's often through a fund. You might come in directly on the cap table. If you do that, you're probably going to have, a larger amount of money. One of the other cons to this versus the real estate, obviously there's no hard asset backing it. So you're making a bet that after doing the due diligence, the company is going to last. You're going to have a successful exit or liquidity event at some point. You may or may not get cash flow from this, depending on the type of investment you made, how you're on the cap table, what that looks like. Private equity can be illiquid, which is a con for an extended period of time before you have a liquidity event or you are able to recoup your initial investment. Whereas real estate, at least you're getting those regular cash flows. The benefit here, like I mentioned before, is the potential for higher returns is significantly greater with private equity versus real estate. So if you're looking at a good real estate deal in the current market, I mean, we've got one right now, like 12% cash on cash is a really good return with current interest rates. 8, 9 on the cap is kind of where you want to be. If you were participating a couple years ago, you might get higher than that with lower rates. The IRR on the majority of properties after 3 to 5 years are going to be somewhere between 20 and 30% in most circumstances, even on any type of property that you're having to build or you're buying and renovating. Those are going to be some good numbers to shoot for on that side of things. Whereas with private equity, you might not get that cash flow, but you might see a 5, 10, 20, 50, 100x return on your money if you're making the right bets in private equity. You're getting in early in a seed round or Series A round for a company. But again, you're going to have to wait for that liquidity event, and that might be 5, 7, 10 years before you see those types of returns. So risk tolerance, time horizon, a lot of those things play into both of these types of investments. And again, you're going to want to make sure that if you are investing in private equity, they do have a good exit strategy in place. So what's that going to be? Is it going to be through an acquisition? They're positioning themselves to get it purchased or acquired by a larger fund, or maybe even a competitor, or a strategic acquisition by a larger company where their suite of services fits nicely within their category, or adds an ancillary product to their scope of offering. You might have an IPO or a direct listing. Both of those could be liquidity events for a company as well. Again, this is going to take longer if you're in early. And you're going to want the right market conditions for that. We haven't seen a whole lot of IPOs over the last 12 months, even over the last 2 years in comparison to, prior to 2020. There's a lot of IPOs during that period. I anticipate that 2024 could be better for that, but we will have to see. So some of the other cons, like I mentioned before, for private equity would be, the illiquidity of it. It's going to be locked up for an extended period of time unless you're working with, some of the new things that are coming out. I mentioned Link2 and some of the stuff that we're building. You have limited control over these investments also. So if you're partnered in a syndication that went in on private equity, you're kind of beholden to the GP as to the time in which you will receive your distributions, or you want to make sure that you're reading the subscription documents and the operating agreement and the private placement memorandum for what you're participating in, and make sure that you completely understand, all of the risk associated with the investment and when you're going to be able to get those distributions, and also what the plan is for the exit that the GP has put in place. And the GP is a general partner. Like I mentioned before, this is higher risk than, real estate, a hard asset associated with it. And then you also want to watch out for the fees associated with syndications that you're participating in. Link2, they do a good job. Like I said, they break it down to a point where you can get in for a lower amount, but they're going out and they're acquiring the private equity at a significantly lower rate than what they tend to be selling it to the investors for. So that's where they make their arbitrage. They're making 30, 40, 50% on that upfront. Not to say that there's not good deals on that platform where there'll be 5, 10x before they IPO. We saw, Coinbase with a 7x from where they listed on their platform that people bought in, which is a fantastic return, especially in a short period of time. Their focus tends to be on unicorns, not in early stage companies, which de-risks you a little bit, which is great. But you're going to watch out for those management fees associated with it. And then also the carried interest that they're charging. Most common for most funds is going to be like a 2 and 20. So the management fee is going to be 2%, and the carry that the GP will take is 20% for putting the deal together. So just wanted to get into this. Again, I want to reiterate, a lot of millionaires are made. If you just want to be a millionaire and to have cash flow, your time horizon might be a little bit shorter to recoup your investment, and you want a tangible asset. I think real estate is probably the asset class to go into. And if you're looking at a longer time horizon, you're looking for significantly higher upside, maybe you're not as concerned about the cash flow, then private equity seems to be the play. And like I said, most billionaires are made in private equity. So if you're watching this, hopefully this has been valuable for you. Again, we would love to have you like, subscribe, and we'll see you on the next one.